to Work in Sri Lanka for inviting me to moderate this discussion. I am humbled because I'm sitting amongst two giants over here. So the topic of our conversation, this fireside chat, is we're going to look at the economy, the economic outlook for the country, what we think Sri Lanka's macroeconomic trajectory could look like, and to talk about a very vital part of that journey, which is what's been done on the digital side. I don't need to go through what has happened in this country. As a country, we've had periods of macro instability in the past. We've been a country which has run persistent twin deficits. We've had a deficit on the current account side, and then we have also had deficit on the primary balance side as well. We've been a country where we've had periods where the exchange rate has been artificially controlled, instances at times at the expense of reserves. We've been a country where the interest rates have been artificially controlled. And then more recently, we've had that rather disastrous experiment with modern monetary theory. But sitting and looking at what has happened over the last couple of years since the crisis, one of the things that we see is that certain frameworks, certain structural reforms have been put in place. A lot of these are reforms which have been long overdue, which I think will make Sri Lanka's macro trajectory a lot more pleasant in the coming years. One of the questions that clients often ask me is, okay, this is Sri Lanka's 17th IMF program. This time round, is it going to be different? And I would like to argue with some of the reforms that have already been put in place, and perhaps with some of the reforms that are yet to come, that it certainly looks like that our macro trajectory could be very different going forward. So I will put that question to Dr. Coomaraswamy. My thesis is that things will be different going forward, and I hope that he will agree with my view. We will also then talk about the digital economy. The digitization does two things. One, of course, it increases efficiencies, reduces leakages, but we also got to remember, I think Dr. Hans was quoted saying that there's a plan to make the digital economy 15% of GDP in the next 10 years, from about 3 to 4%. So I'd like to ask him what we are planning on doing to get to that. But first, Dr. Coomaraswamy, looking at some of the reforms that have been put in place, you've been talking about a new paradigm for macroeconomic management, a phrase that I also I've borrowed from you and have used quite a bit. You've spoken about the 5 pillars on which this new paradigm is based. So perhaps you can tell us a little bit about what this paradigm is, what those pillars are, and whether you believe that this time around things could be different. Thank you.
Thank you very much, Naveen, and let me thank LYNEAR as well as the organizers for inviting me to participate in this event. I do fervently believe that this time around it can be different. I'm not saying it will be, but it can definitely be different because I think the circumstances are quite different. And why do I say that? Before that, let me just give a bit of historical perspective. As all of you probably know, Sri Lanka was second to Japan on almost any socio-economic indicator in 1948. We were ahead of South Korea and Singapore per capita GDP in the mid-1960s. Today, Singapore's per capita income is over 80,000, South Korea over 30,000. I think we were 4,300 at the end of last year. So clearly there has been a severe regression, and if you ask why that has happened, there's complex causality. There have been social problems, there have been political problems, and there have been, I think, economic problems. And the most significant, in my view, have been the repeating bouts of macroeconomic stress. You can't have a stable platform in terms of policy and have a stable investment climate if every 2-3 years you're changing your tax regime, you're having to depreciate your currency dramatically, you have to shift interest rates up and down. So with that kind of instability is something that you're very familiar with, and it is not a conducive environment for investment. So what is different this time? Why am I saying that actually we have a much better shot this time than we have had in the past? And there are these 5 pillars on which the new paradigm for macroeconomic management is being built or has been built. The first pillar is the Public Finance Management Act. The government's fiscal performance has been the main source of instability in the Sri Lankan economy as far as the macroeconomic outcomes are concerned. And again, a toxic combination of populist politics and an entrenched entitlement culture amongst the people. We can't put all the blame on the politicians. I think we have to take some of the blame as well. As this combination has meant that each time there's an election, there is a slippage in discipline. Interestingly, yesterday or day before, the Director of Economic Research at the Central Bank, Dr. Sujita Jagadevan, gave the tax oration, I think they call it. And if you look at slide 5 of that oration, she compares Sri Lanka's very first IMF program, taken in 1965, with the current one. And there are very striking similarities. We had the same problems. We hadn't fixed them. The budget, the balance of payments, reserves, all those problems which were there in 1965 are still here. So that shows, Einstein said that the definition of insanity is to do the same thing again and again and expect different outcomes. That's what we've been guilty of. But now I think we are beginning to see a different perspective. And one is the Public Finance Management Act. At the center of it is the primary surplus. If you're running a primary surplus, your budget deficits shouldn't be unsustainable. You should be able to manage it in a way that doesn't create overheating in the system. And now we've had, I think, a couple of years of primary surpluses. And hopefully that is from 1954 onwards, there have only been 4 years. Between 1954 and 2023, I think it is, there have been only 4 years where Sri Lanka has had a primary surplus. In all other years, we have been borrowing to meet the current year's expenditure. But now that we've hopefully turned the corner, what does the primary surplus do? It stops you from having unsustainable deficits which overheat the economy by pumping in too much excess aggregate demand into the system, which creates inflation and balance of payments pressure. So if we can turn the corner on that and maintain a primary surplus, hopefully that source of instability will be taken out. The second pillar is the Central Bank Act. Historically, the Central Bank has been guilty of fiscal forbearance in 2 ways in particular. One is the deficit financing. The Central Bank has participated in the primary auctions for treasury bills and has from time to time pumped money into the system through that. And also it has artificially kept interest rates down. That is financial repression. Again, that overheats the economy by creating excess credit, and it's again another cycle of too much demand and overheating. So both those sources of instability are no longer possible. The new Central Bank Act does not allow the central bank to participate in the primary auctions of treasury bills. So the central bank can't print money for the government anymore. Secondly, the regime for interest rate formulation, the flexible inflation targeting regime, is data dependent and forward-looking, and so you can't have these administrative fixes of the interest rates as we've had in the past. Even as late as, I think, 2021 rather, we had the 1-year treasury bill rate pegged at 5%, if I'm not mistaken. And clearly that dragged the whole yield curve down and created overheating in the economy. You can't do that anymore. So 1, no financial repression. 2, no deficit financing. These are 2 big changes. what we are doing is, as a government, I don't know whether they were fully aware of it when they did it, but they've tied their hands, in a way they've never done before. But
Which is a good thing.
Pardon me?
Which is a good thing.
Which is a very good thing. So whether they know it or not, they have done it. Of course, they can undo it through an act of parliament. But this is where everybody comes into it. We need to make sure that we protect this new paradigm. So those are two pillars. Let me get through quickly. The third pillar is the Public Debt Management Act. It actually now harmonizes the institutional architecture for managing public debt. In the interest of time, if you want more detail, I can say it. But what this new system does is you can have a more holistic approach, and it also takes away a conflict of interest for the central bank. The central bank in the past has been expected, A, to raise money as cheaply as possible for the government, and also to make sure they contain inflation. And sometimes there is a contradiction in those objectives. So that's the third one. The fourth thing is the cost-reflective pricing. It has had a positive impact on the budget, government budget, positive impact on state bank balance sheets, and also it has pushed us into the right instrument for social protection, which is cash transfers, which are targeted, rather than these untargeted subsidies which we had before, which actually benefited the non-poor more than the poor. So these are, again, a positive move in the right direction, and I think there are still some cleaning up to do on the assessment scheme in terms of inclusion and exclusion problems, but at least we've got the right instrument now to do the social protection. The fourth, is that the fourth? 1, 2, 3, 4. Yeah, I think the last one. The last thing is addressing corruption vulnerabilities and governance weaknesses. The new Anti-Corruption Act actually is very strong and can, if implemented properly, make a very big difference. People can say, what does corruption have to do with macroeconomic management? Well, corruption is actually an implicit tax on development because it increases the hurdle rate of return and also often distorts resource allocation. And so cleaning that up is critical, and I hope that we are on the in the right direction on that as well. So these 5 pillars, if they're kept intact, I think will make sure that we are in a new paradigm, and I think we will have more stability. So what are the implications of this? We will have more stable and lower interest rates. We will have a more stable currency, means we won't have a fixed rate for the currency. It'll fluctuate, but it'll fluctuate within a narrow band. Because under the flexible inflation targeting regime, the exchange rate is managed flexibly. So going forward, central bank is managing the exchange rate flexibly, so there will be some movement depending on the supply and demand dynamics in the FX market. But you won't get these dramatic movements in the currency which disrupts everything. So take all these things together, and I think we have a good framework in place, a new paradigm which will give us more stability. And I think the critical thing is investment, right? That is what we need to get. And the investment climate has to have a stable macro framework to operate on. And I think we are beginning to get there. Thank you.
Thank you, Dr. Coomaraswamy. Dr. Hans, if I can turn to you, it looks like we are going to have we could have a very stable macro environment over the next few years, and certainly beyond the tenor of the IMF program as well. The next thing is growth. It's quite possible that we may have missed the bus in terms of becoming a manufacturing economy. So the next step is the services economy, and part of that is the digital economy. What are some of the plans that you and the team have on that?
Yeah, I think first of all, it's an honor to be here. Thank you for the invite. And of course, it's always an honor to be alongside Dr. Indrajit. The macro stability, I think, is the baseline. So that's a prerequisite, and also the fundamental layer of platform for growth. I believe the business as usual growth on the backdrop of a fundamentally strong, stable economy, Sri Lanka would be growing at anywhere between 4 to 5%, I believe, on a business as usual basis. Now, I'm a sideshow, the digital economy growth strategy, as well as the blueprint, which will bring together the various components of the growth equation. Digital growth or digital-led growth is not investment-driven growth, because I think we have to start from the premise, or a conservative premise, that we don't have a very abundant or liberal fiscal space to put too much investment behind growth. Investment-led growth would be the traditional way of growing. Put money into large infrastructure, create a lot of jobs, and the long trajectory and payback period of those investments bring about risk in the short run. Now, using digital means to generate growth, the growth comes from three sources. One is digital innovation, meaning export diversification, creating service exports, for example, digital exports, which flows right to the bottom line of the economy, because those are exports or GDP, sources of GDP which didn't exist at present. Second would be productivity and efficiency, and thereby creating more headroom and more fiscal space through productivity and efficiency for traditional growth. And last but not least, growth which comes through competitiveness. Means the competitiveness of our economy helps us win in multiple markets, and thereby you generate the growth through this sphere. So these factors have been shown to come together. There are examples, India, many other countries, where there's apparent or causal, not apparent, causal relationship between the growth of your digital economy and the uplift you get on your normative growth rate. So country, for example, a country which is growing normatively at 4 to 5% could get a kicker of 2 to 3 points of GDP growth if their digital economy is growing very rapidly. And India is a very good example of this. Huge denominator, huge economy, consistently growing at north of 7.5%, 8%, targeting 10% by 2030. So that kind of growth rate can come only with a kicker of productivity, competitiveness, which runs across the socio-economic pyramid as well as the economic architecture of the country. So that's where the uplift comes. So the attempt to move our digital economy from 3% or so today to 12+% by 2030, which would translate to moving a $3 billion digital economy to $15 billion, 5x in that same period. Why do it? Is to generate through those three mechanisms I mentioned an uptick on the normative economic growth rate. And when you do the maths, you add 1 or 2 points, maybe you start with 1 point, 2 points for the next 2 years and 3 points over and above normative growth over the next 5 years, and you do the maths on a $100 billion economy today, you'll come up with a number north of $25 billion in this period, the sum of the gain. And that would then add to the growth across multiple segments of the economy. So what are we doing about it? There are multiple strategies. One is focused on digital exports, and that is to increase the competitiveness of our digital companies, attract majors to come into Sri Lanka to partner with our companies, create overseas markets for the products and services of our digital ventures. The target there is to move from around $1.8 billion today in digital export to $5 billion annualized. Again, if you do the math over a 5-year period, that will account for approximately 1/3 of the gain that we are trying to achieve. But the rest, the productivity, efficiency, competitiveness, comes from multiple layers of the economy. And if you look at the components of the digital economy, the narrowest definition is electronic transactions. Electronic transactions, spending on broadband services, spending on connectivity, all the payments we make, etc. So that's the narrowest definition. And you can't really, even if you convert a major portion of your economy to digital in terms of transactions, you can't really move the needle in terms of competitiveness. So the next layer comes from platform economies, the shared economies, e-commerce, ride-hailing, plus the various other forms of shared economy. And that gives you the next layer of gain in terms of the layered digital economy. But the real kicker comes when you have digital tools, digital methodologies, led by AI, of course, penetrating all segments, all sectors of the economy. So we are talking about digital health, digital agriculture, tourism, digital means and digital raw materials and digital methodologies moving into all sectors. That's when you start really getting into the higher end of exploiting of digital technologies. And personally, I feel that that we are really on a double-edged sword. On one hand, yes, this is a source of cheaper growth, safer growth, because you're growing through muscle, you're not growing through consumption or throwing money at a problem. It's throwing ingenuity, it's throwing productivity, efficiency, and so on. But on the other hand, I don't think you can afford not to do it. Because if you don't digitalize your economy, if you don't digitalize the multiple sectors of your economy, you will lose competitiveness. And I believe that the world is moving in the direction of a very polarized space in terms of competitiveness or national competitive advantage, especially with AI, because AI would sit at the sort of epicenter of our economy. And if you're not expert at it, if you don't adopt, if you don't use it in all your processes at a production level as well as a service innovation level, those countries that do and those countries that don't will be separated by a very, very incisive gap. The AI gap is far more incisive than the digital gap, and the digital gap would be far more incisive than any other form of gap between those who do and those who don't, or those who have and those who have not. So hence the requirement to be very expedient now in terms of building our digital muscle and capabilities, not only across sectors, but also individually as participants in the economy, as stakeholders in the economy, that every single individual will need to build that muscle.
Thank you. I think we have some time for questions. There is a QR code that you can post your questions on. Until we get any questions on this, Dr. Hans, one of the challenges perhaps may be labor. And this is where attracting some of the Sri Lankan expats who are overseas, who may want to come back, how much of a challenge is labor and what can be done to facilitate that?
In the digital space, it is a challenge because of, on one hand, the opposite of what we are trying to achieve here today, attract Sri Lankan talent back, is the migration.
Exactly.
And the brain drain as opposed to the brain gain. However, whichever way you look at it, I think Sri Lanka is a small market. Therefore, we have to be very focused in our talent as well. We have to carve ourselves a niche in the digital capability space. But talent retention and growth and scale will be a challenge, and we are applying multiple strategies to grow the talent pool. Today we have around 100,000 a digital workforce of around 100,000, aim is to double that. But 3-5 years from today, I think what you would define as a digital resource may not be the same as what we see today. I mean, we don't need a 4-year degree to be a productive digital resource. Right. I think an A-level graduate can be a part of this workforce, or even younger. So how do we, the question is how we harness all that potential and rapidly to generate growth.
Right. One of the pillars in Dr. Coomaraswamy's 5 pillars is the 5th pillar, which is on corruption vulnerabilities, and digital can play a large part in reducing some of the leakages that we have in the system. Can you talk a little bit about very quickly in terms of what some of the initiatives that have been done on that side?
So transparency is a key characteristic of a digital economy, because everything is transparent, subject to data privacy and data protection laws and so on. That's a fundamental. Also, the digital identity, for instance, will serve to make the various individual linked activities much more streamlined. Taxation, for instance, I don't know whether that's good news or bad news, but taxation and also broad basing and broadening of the tax net all the way to whether it's indirect taxation or direct, much easier to implement in an environment where there's a digital ID. Just a couple of examples.
Right, okay. We have got a couple of questions in. I find it a little bit difficult to... Ruin, you had a question, maybe you can just say it out.
Impact that you spoke of.
Yeah, so in the first year, the payment space is one that we considered a quick win, and bringing the ecosystem together, the government payments, as well as various offshoots from government payment, the offshoots from the government payment platform like traffic fines, etc. That was one key win, and that's continuing to grow. Many of the other efficiencies in our digital ecosystem will come from horizontalization. What I mean by this is that in a brownfield digital economy, which Sri Lanka is very much a brownfield, we are not nascent. Nearly all government institutions have good systems. Nearly all, not all. They have good systems, but they're not connected to each other, they don't talk to each other, and there's no single linkage, such as the digital ID, which can carry across. Similarly, constructs like the National Single Window, which again would link multiple organizations based on a single identity or a single business identity. So the real uplift of our digital economy, in my view, will come from horizontalization, and secondarily from institutional systems being further enhanced. This takes a little time because you have to build what are known as digital public infrastructures, which are software layers, the digital ID being one, the national data exchange allowing data to be transferred between entities, the data and cloud infrastructure itself, and opening up all the payment networks. That said, I think the time frames, I'm not talking about long term, it's a medium term. So the first 2 years will be spent really on building these infrastructures. And that should open up a lot of potential almost immediately.
I think we have time for one question. Dr. Coomaraswamy, there's a question for you. The 5 pillars that you mentioned, were they strategically planned by the government, or are these pillars what you've personally identified? And I guess what the person is asking is, do you believe that the government is seriously looking at these pillars, and do you think they have the capability to execute on what needs to be done?
Actually, these pillars were part of the previous EFF program that was implemented during the period 2015 to 2019. So, in a way, there's been a fair amount of consensus around them, but in 2019, at the end of 2019, beginning of 2020, there was a total policy reversal. We had a primary, Mangala Samaravira was able to achieve a primary surplus in 2017 and 2018, which were, as I said, only 2 or 4 since the 50s. We were able to also get the central bank bill into Parliament. Couldn't quite get it through before time ran out. So a lot of these things were very much in the making during 2015-19. But then we had this total policy reversal. So this is the key thing, to have consistency across political cycles. This time it's more encouraging. Actually, the person who went to the IMF, who changed course and went to the IMF, was President Gotabaya Rajapaksa. Hans was then head of the Ceylon Chamber and knows this process well. So he started the process. Ranil Wickremesinghe negotiated the IMF program, and President Anil Kumara has been able to sustain the program. This is very unusual for Sri Lanka. Even more unusual for Sri Lanka is not to change key officials. The governor, Nandalal Veerasinghe, whom I think is doing a great job, has been kept on. And even Mahinda Sirivardhana was there through 2 cycles. Plus, they brought in Dr. Harshana Surya Peruma, who was part of the Treasury setup to BST. So this kind of continuity is very unusual for Sri Lanka. So hopefully, it's encouraging that, there's a story, apocryphal perhaps, I don't know, time is up, so I better be quick. When the Indians had that crisis in 1991, they had a very tough IMF program. Manmohan Singh was finance minister. He went to his Prime Minister, Narasimha Rao, and said, Prime Minister, this is a tough program. It's going to be very difficult for you to sell this to your own government, leave alone get it through Parliament, and sell it to the people. And Narasimha Rao had said, give me 10 minutes, I'll come back to you, whether I'm prepared to go ahead. 10 minutes later, he called and said, okay, go ahead. So Manmohan Singh was utterly confused and wondered how this, you could pull this kind of rope trick off. And he asked Narasimha Rao, how did you do this? On what basis are you saying this? He said, well, look, I had to make one phone call. I telephoned Mr. Vajpayee, the leader of the opposition, told him this has to be done for India, we need to do it. And Mr. Vajpayee told me, go ahead and do it. We will shout, but you go ahead and do it, we won't bring you down. So that's the kind of consensus and far-sighted political leadership that we need.
Thank you. We have now come to the end of the session. The screen is flashing red. I think the conclusion is that it appears that this time round things are different. It looks like Sri Lanka may be looking at an extended period of macro stability where we would have more stable interest rates, stable exchange rates, inflation should be under control, an environment in which businesses can be formed and businesses can certainly thrive. When you look at Sri Lanka in the past, one of the fundamental problems we've had is that politicians have made policy decisions looking at election cycles. And as a result, a lot of these policy decisions have been short-term in nature. But this time around, it appears that we have a set of frameworks that have already been put in place, there are more frameworks that appear to be in the pipeline. All of these frameworks, we may only see the benefits beyond the next election cycle. And I think it's very important for us to understand that, a lot of people come and say nothing is happening, things are too slow. But the reality is that in a lot of these frameworks that we put in place on the economic side, we are already seeing the benefits. But certainly on the digital side, as Dr. Han said, we are looking at benefits that we might see in the next 5 to 10 years. So it's very important that we here understand the importance of these frameworks, and more importantly, understand that we will only see the benefits of these across election cycles. And we have a duty to inform people that we know of the benefit of this. And because historically, we've had this situation where politicians make a lot of noise, people get activated by noise, and people equate political activity with progress. Sometimes activity does not translate into progress, and sometimes progress isn't very loud, and it's important that we understand that. Thank you.
I think it's up to all of us to protect this new paradigm for macroeconomic management, because it's a public good which needs protection, and we need to shout and scream, and if there is a deviation, we need to make a big, big noise to make sure that doesn't happen.
Absolutely. I'll be utter shame for us to undo all those really hard reforms that we've done in the last couple of years. Thank you very much.